Welcome to A Course to Retirement with Grand Rapids Certified Financial Planner Ron Courser. Ron Courser and Associates are planning today for the potential of tomorrow.
And welcome into Your Course to Retirement, Grand Rapids resource for a common sense approach to planning for your financial, investment, and retirement future are the team at Ron Courser and Associates. And with us today, we have Nolan Goslee, the Associate Planner there at Ron Courser and Associates. Nolan, welcome in.
Hey, thanks so much. Glad to be here, Peter.
Yeah, Ron often talks about you, but we don't see you much here on the program. So if you would, you are a planning partner there at Ron Courser and Associates, correct?
Yep. Yeah, planning partner with Ron, basically within our office. Ron and I handle the wealth management side of the business, and Ron's wife, Nancy, takes care of all of our healthcare initiatives, our healthcare side of the business and everything like that.
Health and wealth, all under one roof there.
Yeah, we try and take care of all of it.
That's fantastic. Well, tell us, if you would, Nolan, we do hear a lot about you. Ron talks about you on the program pretty frequently, but I don't think we've had the opportunity, at least not recently, to kind of reintroduce the audience to you. So if you would, give us a little bit of your story and your background.
Sure. So Ron and I started working together about 4.5 years ago now. We started working mid-2016. Him and I got off on the right foot because both of us are Army veterans. I actually met his wife before I met him. She interviewed me a couple more times before I even met Ron. But we both have a very similar work ethic. We both come from military backgrounds. We both treat clients with a good deal of respect. We try and teach people first and foremost. And I don't know, it just kind of made sense for Ron and I to work together. I kind of come from a similar background from him. We both worked for insurance companies for a while before we went fully independent. And we both love being independent. One of the main benefits of being independent financial advisors is we can operate on a fiduciary capacity, operate in our clients' best interests. And that's what we base our practices on and what is most important to us in the planning process.
How did you go from your service in the military and the Army to then being in the financial services field, insurance, and now as the independent planning partner there at Ron Courser and Associates?
Sure. So kind of a funny story, the way that I joined the military. I come from a military family. I come from a military background, not my dad, but every one of my cousins and uncles and grandparents were all in the military. I joined the military a couple years into my first 2-3 years of college because I didn't have enough money to go to the college that I wanted to. I joined the Army, became a mechanic of all things in the Army. I tested pretty well in a variety of different areas, but that was the one that had the biggest signing bonus, if you could imagine a 19-year-old kid jumping at a signing bonus. So from there, I did active duty in the Army. Once I got out or close to getting out of the Army, I realized I really, really enjoyed the people aspect of it. And while I enjoyed helping people with people problems is one thing, but helping people with financial problems is another. I find that financial issues are something that are usually pretty actionable and things that I can usually solve with relative ease. And so that's why I kind of transitioned from, mechanic in the military, kind of developing into a little bit more of a personal person with some things to add and some things that we can really do here to make it special using that background, using that experience, not necessarily the mechanic aspect of it.
Well, mechanics and money do make sense to me that they correlate. I mean, a machine, it works or it doesn't. There's not a lot of emotion. Well, it feels like this, it feels like that. And, not to say that there's not emotion behind money. There is. There's a lot of emotion behind our money. But the math part of it, it sort of either works or it doesn't. So like you said, helping people with people problems, that's one thing. But not everybody has a great grasp on their finance. And I think that with the mechanical background, understanding either logistically what works or what doesn't, it might have lent itself to the money side of giving people advice and helping them.
It certainly eliminates a lot of the gray area. It kind of makes it so that something either works or it doesn't work. And so it takes a lot of the guesswork out of it. It allows me to, make decisions a little bit better and a little bit more actionable as far as the way that we do things. So yeah, certainly lends credence to that.
Military is all about being able to make those decisions as well. And so having to execute on decisions, follow them through. Do you think that has benefited you in your venture into financial services and now in your time and career as a fiduciary planner?
For sure. Yeah. I think that it kind of gave me a good starting point, a good first stepping stone as far as how to act, how to treat people, a creed that you can live your life by, essentially. So translating that into the financial services industry, I mean, it just makes sense. Working from a fiduciary capacity, we do things that are in the client's best interest. And when, I can honestly say that doing something in a client's best interest aligns well with my moral philosophy and aligns with that client's moral philosophy, and we all feel as though each decision is made in that client's best interest, it takes out a lot of that bias and it takes out a lot of that distrust, I think, that can build up over time. So.
Well, we are here again with Nolan Goslee. He is the partner there at Ron Corser and Associates Grand Rapids, your resource for that common sense approach to planning, helping you make those decisions, execute on them, and then continue to monitor the progress and make sure that you are doing the best things for your financial future. If you've got questions or concerns, they always welcome calls from listeners or viewers to the program, and they do offer a complimentary review of your financial situation, your accounts, your investments, your strategies that you are implementing, making sure that you're doing the best things with your money. Give them a call if you'd like to get a quick answer to a direct question, or if you'd like to take them up on that holistic complimentary planning review. 616-301-2581, 616-301-2581. And Nolan, reintroduction to you here on the program, but don't want to miss the fact that this is the first show of a brand new year. Kind of a deep breath sigh of relief to get 2020 over with.
Sure.
Well.
Yeah. It feels good to be in 2021, doesn't it?
Yeah. Finally. And I'm sure we've got a whole store of adventure awaiting for us in 2021 as well, but it does feel good to finally be here.
Yeah. Yep. 2020 was certainly an adventure from the smallest to the biggest events that we could possibly have in a given year. So yeah, it feels good to be done.
Well, we've got some of it behind us. We're still dealing with a lot of the adventure of 2020. I think is going to carry over for quite some time and be with us. Doesn't seem like this virus or the pandemic is going to go anywhere anytime soon. And even with the advances in the vaccine, I don't think that's going to have a widespread effect globally for quite some time. But I know that people are still dealing with financial issues. You mentioned a word a couple times as we were talking about your background, fiduciary. Can you talk to us about what a fiduciary is and in 2021 here, the importance of a saver, an investor, a retiree, a pre-retiree, having a fiduciary on their side as their planning partner?
Sure. So in order to operate from a fiduciary capacity, we kind of have to step back almost 100 years at this point. A lot of our investment regulation was outlaid in the Investment Act of 1934, and then the subsequent act of the Investment Advisory Act of 1940. Now, the majority of what we do as fiduciaries is guided under that second regulation. Essentially, what that regulation does, it has us operate under a fee basis for planning rather than operating under a commission basis. Now, what that does when you operate giving advice for a fee, it's a little bit different. You're not charging a sales charge to each individual transaction. You're not churning one mutual fund to another because you might get a different incentive. You're not selling one product over another because you may win a trip for it. Fiduciary advisor takes a slightly different approach where they do, in earnest, operate in your best interest. Best interest is kind of subjective. I think there are a couple regulatory bodies that are trying to identify what that specifically means. But what it means for us is not only does an investment have to be suitable for your situation, but it, through all of our due diligence, has to, in our opinion, be in your best interest to invest in that. So if that's the difference between choosing one fund company over the other because one fund may have lower expenses, that's the research we do. So not only is the investment suitable, but we've done enough research and due diligence that we know that it's in your best interest in order to be invested in this manner.
Now, you mentioned several regulatory bodies are sort of pushing or pursuing this as a cause, which I think is absolutely appropriate. I think that the average investor needs to be assured that their advisor, their source of guidance and perspective is giving them suggestions in their best interest, but it's not, still to this day, not necessarily a standard that all financial advice or financial advisors have that fiduciary quality about it.
Right. Right. And I think you find those advisors a lot in the more commercial shops, or you may even find them in your bank sometimes, where it's a very transactional relationship. You find yourself going in there maybe once a year, maybe not even once a year, and all you're really doing is getting asset allocation recommendations. If that sounds like you, we try and do a little bit more than asset allocation here in the office. Not only do we take a look at the investments themselves, but we make sure there aren't redundancies. So you don't have tax-free investments in a tax-deferred account, or you don't have too much money in a traditional IRA when your goal is to, maybe withdraw more out of a Roth IRA, or you want to couple your investment recommendations with healthcare, with long-term care. And so a lot of shops, I think, kind of miss the boat on that. They try half of the retirement puzzle, but they don't really try and get the holistic picture. And that's what we try and do. And that's what makes us just a little bit different than a standard shop, where you're just going there and, they'll put you in a 60% stock, 40% bond portfolio and see you in 3 years. That's.
So if I show up with $10,000 to invest or $100,000 to invest, and they say, fantastic, we're glad to see you and your money. We've got this mix of investments over here. We'll put you right in. That might be an indication that we're not getting that fiduciary quality, something that's in our best interest. Where I guess my question there is, how should the conversation start, and how is it different if we are talking to a fiduciary?
Sure. So usually a conversation starts with a fiduciary with a discussion or a discovery session. We call it discovery. It's called a variety of different ways, but essentially it's the opportunity for any client or any prospect, or not even a prospect, just somebody that wants more information, has an opportunity to come in here and ask us as many questions as they want to. Our entire goal in the first appointment is just to answer questions. If you don't have too many questions, you don't have to have too many questions. I can easily talk for an hour and have you sit there. But when you come with questions and you say, have I done this the right way? Is my old methodology of having so much money put pre-tax still working in our low tax rate environment? Methodologies that might have been taught to us by our parents and grandparents, are they still functional? Is your retirement going to look like your parents' retirement? And all of those types of things. Most times when we're in a first meeting and we're going through that discovery session, what we're really trying to identify there is, do you have an income gap? And that's usually our first thing that we like to approach, is that income gap idea. What do you get from your guaranteed sources? What's your income need? And then how do you fill it in with the rest of what you have? So that's kind of where it starts. But from there, we help people when they turn 65 sign on for their health insurance, for their Medicare supplements, their Medicare Advantage plans. We help people shop Affordable Care Act coverage versus COBRA coverage if you retire a little bit early. We help people with withdrawal processes out of 401ks if they retire early. So there's a whole lot of different ways and different approaches that we take there, but really it's about, who are you as the client? Who are you as a person? And what are your goals? Are they achievable? Can we measure them? Are they actually actionable, or, are they a little too vague? So trying to identify some of those places we can go, places we can look to achieve different objectives in a variety of different ways, not just a one-size-fits-all approach.
And again, if you've got questions, concerns, if you'd like that complimentary review, pick up the phone, give Ron Courser and Associates a call, 616-301-2581, 616-301-2581. And as Ron has talked about on this program before, Nolan, it's not the philosophy there at Ron Courser and Associates to hold your clients to some investment minimum. You guys don't necessarily have hard and fast account minimums. You're sort of willing to help anyone get headed in the right direction. That being said, certain strategies are going to be better fit for certain types of clients and folks with certain amounts of investable assets and net worth, correct?
Exactly. And I mean, I have friends, my age, younger than me, that open accounts with as little as $500. It does not matter to us whatsoever how much money you have. We just try and help people. But yeah, the strategies do get more advanced the more money that you do have. We hit kind of certain thresholds where new investments or maybe new areas open up to us as far as investment capital goes that you just simply cannot invest in if you only have $1,000 or $2,000.
Sure, that makes sense.
Yeah, aside from like the occasional insurance product, I would say most investments you can invest in with a very minimal dollar amount. So you can invest a whole lot of small money just like you'd invest a whole bunch of big money.
Well, you mentioned the term income gap, and we've had pretty extensive conversations about planning for retirement and the need to identify that income gap. A 35-year-old necessarily isn't going to encounter a big problem with an income gap. This is something that a 60, 65-year-old, someone who is preparing for retirement, that is a term that they are specifically going to have to pay attention to and address in their planning, but different stages of planning for different individuals.
Correct. And what we try and do is approach, I guess, all three areas of the planning process. There are traditionally three different ways that you handle money throughout your life. You either are in your accumulation phase, like I am, where I'm trying to sock away as much money as I possibly can, get a very good return on investment, but take significant risk because I have much, much longer than 10, 20 years until I want to start accessing this money. So I'm in my accumulation phase. Now, I just had a conversation with a client this morning who's trying to get over the hurdle of no longer being in his accumulation phase. He doesn't want to start taking money out. He wants to continue saving because that's what he's done for 42 years.
Sure.
But once you enter into this distribution,
it's a state of mind,
yeah,
right?
Right, exactly. And I mean, it's getting over entering into a new phase of life. I think of it like, kind of like a midlife crisis, but it's an end of working life crisis. So transitioning from that accumulation phase to the distribution phase is a huge hurdle to get over. And that income gap or that income need that's generated from your portfolio is when you make that transition. So that's when you go from accumulation to distribution, when you now have to start filling in the gap of your income. If you get $3,000 from Social Security and otherwise, and you have $4,000 per month that you need, then you need $1,000 to be generated from that portfolio. So that enters your distribution phase. At the very end of the line is when people hit capital preservation. And usually when you're hitting capital preservation, you want to hold on to as much as you can. You want to leave a lasting legacy. You want to leverage your dollars so that they can be used better in order to pass on assets to your kids or to whatever beneficiaries those might be.
And
so yeah, you're exactly right.
At Ron Corser and Associates, part of your job is helping me identify where I am at in those phases and how I can, as successfully as possible, kind of transition to the next one.
Right. That's exactly right. And not only the financial hurdles, but the mental hurdles too. I mean, we do act as a kind of a behavioral financial coach here. A lot of this is, I can't get over the mental hurdle of having to retire. And so, how can we approach this? How can we put some of your issues at ease? If there's any pain points, how can we help alleviate some of those? So, it's a little bit more than just take your money, put it over here, talk to you when you retire type of thing.
Now, retirement might not be for everybody. I mean, I know that there are folks in my life and my family that have not done well in retirement from a mental standpoint. They wanted to, after a short period of time, kind of get back to doing something, to being more active.
Yeah. Yeah. We do have a fair amount of clients that do that. We have clients who retire early and take on a part-time job so they can keep getting benefits. We have clients that retire and then take on a part-time job because they're bored, a wide variety. And so, again, kind of as a behavioral financial coach, one of the things that we talk about is something called withdrawal rate risk. Now, withdrawal rate risk is the risk that you withdraw too much or too little from your retirement portfolio. Now, too little may seem like a counterintuitive message if anybody's listening to this. Right.
But if I could have done more with my life, it is.
Right, exactly. And a lot of people see this as, okay, I'm going to fill up my income gap, but I'm going to ration my food because I need to fall under a certain amount of income. Well, coaching people into actually using that money and enjoying their retirement is part of that process as well. So making sure that you don't shortchange yourself and making sure that you're actually enjoying what you're doing in your retirement years, instead of just penny pinching and not really being able to live the way that you wanted to all of your working years.
Yeah, because it's ultimately money is not the most important thing. If it was, we would just continue working for more money. But the enjoyment, the confidence in being able to go out to eat or go on outings with our loved ones, with our spouse, with our families, taking trips, those are really the things that life is about, not just retirement, but life in general. We trade a lot of our time for the money to be able to do those things and support those things at a certain point in time. We want a plan to give us the confidence we're going to be able to do the rest of it without trading our time for money.
Exactly right. And finding that time and finding the balance and finding exactly how each little piece falls into line is what we help with. It's when do I start Social Security? When can I postpone it? When do I start drawing for my assets? How's it going to be taxed? All of that kind of stuff should all be wrapped into the planning process. And if your advisor operates on a fiduciary standpoint, it's their job to do that for you. So, if that's what everybody should be receiving from this type of service.
Well, sure. Again, if you've got questions, concerns, if you'd like to talk things over, if you'd like to understand what a fiduciary planning perspective looks like and how that can make a difference in your results and your outlook, pick up the phone, give Ron Courser and Associates a call, 616-301-2581, 616-301-2581. You can go online, roncourser.com, lots of tools, calculators, reports, previous editions of the podcast, resources available online, roncourser.com, and you can definitely be in touch with the team that way, or give it a call, 616-301-2581, 616-301-2581. You mentioned taxes. Looking back again, first show of the year here, we've been in a pretty advantageous tax environment, but during a lot of the last year or so, there was a lot of discussion on what change could be around the corner as far as tax environment and tax policy and tax rates. And how are we planning for that today? And what advice would you give to a saver or investor looking forward and trying to pay as little in taxes as possible?
Well, first and foremost, any advice that I can give to a possible saver or investor is just understand how the government works. It is one huge immovable beast that very little can be done overnight with the government. And so, as we were going through 2020 and as we were approaching the election, I read stories about, well, this person's going to raise taxes this much and this person's going to raise taxes that much, or this is going to lower. And that all may be true. But it does take a while for all of that stuff to get around. So we can always talk about taxes in the future and where we feel that they're going to go. I'm of the opinion that because we continue to issue debt, because taxes somehow continue to be lowered, that we are probably going to be in an increasing tax environment for the next decade or two. It may be slow, it may be fast and then plateau, not 100% sure on that, but we are at astronomically low tax rates right now. And, usually when they're astronomically low, there's only one place they can go up. So that's kind of where we see taxes going. Now, rates right now are incredible. One of the things that we can actually say 2020 was good for is making sure that rates remain low in case you want to refinance your mortgage. Sure. That's one of the things that we talk to many people about, whether you're in your accumulation phase or distribution phase. If you have a mortgage, but it's at a higher rate, one of the benefits of a low rate, low tax environment is you can usually get a good mortgage rate on there.
Sure. But it makes it tough if we're trying to live off of our interest or protect our principal.
That's exactly right. Yep. And that kind of gets back to the planning process of what's your tolerance for carrying debt? Are you comfortable carrying payments into retirement? Do you want to get all of your mandatory payments on the books, but excess off the books prior to retirement? Yeah. So yeah, it's all about balance, Peter, for sure.
Well, again, we are talking here with Nolan Goslee. He is the partner in planning there at Ron Courser and Associates, helping clients, helping savers and investors map out their goals, work the plan, and then make sure that their dollars are working efficiently and effectively to help achieve those goals. And if you've got questions or concerns, pick up the phone, give a call, 616-301-2581, 616-301-2581. Nolan, when somebody calls the firm, they actually are prompted if they would like to speak with a financial planning professional advisor. Somebody can call up 10, 15 minutes, get a few questions answered, speak directly with you or Ron Courser, correct?
For sure. Yeah. And we try and make sure at least one of us is in the office at all times, even kind of during the pandemic, because an office presence in our industry is pretty important. But yeah, we try and be available pretty much anytime we're not in an appointment for situations just like that. If you have a question or two, or you want to know what the difference is between a traditional and Roth IRA, or you don't know how much of your money you've saved up is in what type of account, I mean, that stuff's easy, and that stuff's very, very simple to kind of, get under wraps and help alleviate some of that stress. So of course, yeah, one or two questions for sure.
Now, speaking of planning during the pandemic, it was a little harder to get that face-to-face time, and we'd all love to be able to look eye to eye and shake the hand of the person that we're going to for advice. But obviously, social distancing and quarantines made that a little difficult. There at Ron Corson Associates, fully equipped to have those conversations through the ease, the convenience, the safety of technology.
Correct. Yep. And we've used technology, I think, more this year, well, as most companies have, but more this year than most other years. Starting off towards the beginning of the year, one thing that we wanted to make sure that we were doing is keeping a constant communication stream out to our clients. So not only do we have weekly and monthly newsletters that we send out, but one thing that we also did is kind of as this pandemic stuff was happening, Ron and I would host a weekly advisor forum. And so one of the things that we were able to do during this forum is we would essentially have an open link where anybody could click in, anybody could come into this meeting. It wasn't password protected. So we had clients, friends, family, strangers come into things like this and just ask questions. What is the Fed doing right now to alleviate this? Lowering interest rates, like we talked about, was one of those things. Or is there an end in sight? Or do I cash everything out and go 100% to FDIC insured accounts? Or, do I get more aggressive? And so it just allowed an opportunity to keep the conversation going while being virtual and working, from home, from the road, from wherever else. Yep.
I bet you got a few of those concerns. Should I cash out and just put in everything in the FDIC insured account? But oftentimes when that move is made, it's exactly at the wrong time, it seems like.
Yeah, it does seem like when you try and time the market, it works out worse more often than it does work out better. There are certainly instances, think about 2008, for example, where, as you're approaching that type of recession or even entering into that type of recession, a global financial crisis back then, if you took some losses early on and then cashed everything out, it didn't matter if you waited 6 months or so to get back into the market because the recovery out of that recession took such a long time. Whereas the recovery out of the pandemic recession towards the beginning of the year, I mean, if you made the wrong move on the wrong day, you missed a month's worth of gains in about a week and a half. And so, yeah, it's all about finding that balance. It's all about doing things appropriately. If somebody is so averse to losing money and wants to go 100% bond through a market crisis, I mean, that's fine. It's your money and it's your preference. I would always encourage you to do what's in your best interest. And that's not often in somebody's best interest because, again, you do miss out on some of those gains. Historical data always includes market recessions.
Yep.
So.
Yep. Well, we've talked about how difficult it is to time the market because you have to be right twice, get in and get out at the right time, or vice versa, get out and get back in at the right time. Inherently difficult to do it right twice. But ladies and gentlemen, that's why you've got a professional team there at your access. Ron Corson and Associates, Ron Corson, certified financial planner, planning partner, Nolan Goslee with us today. And if you've got questions or concerns, pick up the phone and give them a call. 616-301-2581, 616-301-2581. When we come back, let's talk about the year ahead, 2021. What's in store? What are some long-term strategic planning moves that we could make? What do we need to be paying attention to in the year ahead? We'll talk about that and more when we come back here on Your Course to Retirement in just a moment. And welcome back into the program. This is Your Course to Retirement, brand new program, the first of the year here on this series, helping Grand Rapid area savers and investors have that perspective, have that guidance to navigate the complex financial world. If you've got questions or concerns, Ron Corson and the team there at Ron Corson Associates are your resource. With us today, we've got partner at the firm, Nolan Goslee. And if you've got questions, you can reach the team by calling 616-301-2581, 616-301-2581. Now, it's fair to say that we went through a lot in 2020, but we probably still have a lot ahead of us here in 2021 and all the years beyond that. And of course, we're going to have to plan for anything that comes along. I've I'm sure we've done a few different years in review at this point in time and talked about, all that went on in the year 2020. From a financial perspective, there was some big news, Nolan. January 1st of 2020, the Secure Act became law. It pushed out those RMDs. A lot of people felt a sigh of relief, a little sense of reprieve. But where the government gives us something on one hand, they usually take something on the other. So can we talk about some of the long-term planning implications of that Secure Act and the RMDs versus the Stretch IRA and what we need to know about and consider for our long-term financial goals?
Sure. So one of the things that folks used to do with traditional IRAs is they used to stretch them. For those that aren't familiar with what stretching an IRA is, but it's handing an IRA to a non-spousal beneficiary in the hopes of keeping the principal or the amount that you really pass on to them intact.
Now, I love stretching my dollars. I love stretching this was probably a good thing, right?
Yeah. Yeah.
Okay. You say non-spousal beneficiary. What does that mean?
So could be a kid, could be a niece, nephew, could be grandchildren, basically anybody that's not your spouse that you pass an IRA on to. The non-spousal is important because oftentimes when you pass IRAs spouse to spouse, there are hardly any IRS actions whatsoever.
And that's usually going to be the first person that I would pass my wealth to, right?
Correct. Yeah. Anytime you want to pass an IRA to a non-spouse, but your spouse is alive, you have to have the spouse sign off on it and everybody has to sign off on it. So usually it goes spouse to spouse first, and then you pass on to a non-spousal beneficiary after that point.
So just kind of playing this through, if I have worked and saved and invested and grown my IRA and then I pass away, my full intention is to pass it to my spouse. But we're talking about the implications of that next passing of the IRA most commonly. It's when it passes to the next generation. And this could be long after. I mean, I may have been gone many years at this point in time.
Right. Right. And, the way the IRAs are passed on now, years and years you could have gone past, you passed it on to your wife and then she passes it on to you guys as kids. So now we're talking about your kids that this is affecting. So the way that this used to work, you have an IRA, something happens to you, it passes to your wife, something happens to your wife, passes to your child. That child has the option of either taking the entire IRA lump sum, in which case they would have to get taxed on the full amount, or they can keep the IRA and just take out these RMDs, required minimum distributions, for forever, essentially. So what a stretch IRA did was essentially took you, Peter, by saying your IRA, yes, you are going to pass it on to your kids, but you're going to stretch it by not allowing them to tap into the principal that you pass on to them. Basically, what this does is it would require your children to only take out what the government mandates them to take out each year. That's what a required minimum distribution is. It's required by the government to take out this distribution. So traditionally with stretch IRAs, you'd place that money, you'd limit the inheritors to only taking out that RMD each and every year, and then the principal amount that you pass on in the IRA would continue to grow essentially exponentially, generation to generation to generation, and you could keep passing it down kid to kid to kid to kid. What the Secure Act did was took that ability away. It took the ability to stretch out an IRA from generation to generation to generation and mandated where if you were to pass on an IRA to your children, that IRA must be out of the beneficiary IRA within 10 years. And that's the big factor that they changed in there this most recent time.
So giving us a little bit of a reprieve on the front end, because RMDs apply to our own life and our own account as well. Those were the required minimum distributions. They gave us an extra year and a half there, but they essentially took away 2 or 3 generations of compounding tax deferral on the back end. So it seems like they knew what they were doing and trying to collect a little bit more tax revenue more quickly.
Yeah, and that's when we talk about taxes, these are the things that we'd like to talk about, because this is not what is your tax bracket. I mean, that's a very simple question. You just have to figure out how much money you make, and that's what tax bracket you're in.
And how can I lower it?
Yeah, exactly. How can I lower it, and how can I get out of tax brackets?
Well, an inherited IRA that I'm now having to completely liquidate and withdraw within 10 years probably is doing me no favors in lowering my tax bracket, even as that beneficiary.
Correct, because any money that you take out of the IRA is treated as ordinary income. It's treated as normal income, as though you were earning it.
On top of my regular salary.
On top of your, yeah, exactly. So if you take this IRA that's $500,000, $100,000, $50,000, whatever, and pass it on to your kids, well, not only do they have all of their income, but now they're required to take out additional income from this IRA, which then increases their taxes, which, it might not be welcome to some people. I mean, more money, more problems, right? More taxes and everything like that. So, that's just kind of what happens. You pass on money to a generation and the generation has to take the money out. But this is a little more heavy-handed, I think, than the government has been before. And it does seem like it's just, we've given you a wonderful tax deferral, pre-tax benefit all this time. Now we need our IRA money out and we want that tax revenue.
Well, and some people are going to say, well, I'm giving this money to my children, so I'm going to let them worry about that problem. Fair enough. I get it. You've worked, you've built it up. If anything happens to be left over, the kids get it. It's sort of their problem to deal with. But at the same time, I might turn around and say, well, who would you rather leave that money to, the IRS or your children? And I think that we might put a little bit of a different perspective on that, because you can plan proactively and still probably accomplish the goals that we had of achieving that generational wealth more efficiently and effectively, if we are proactive in the planning, right?
Right. And I mean, I think that's just where having an advisor, especially a fiduciary advisor, comes into play. I mean, I help people from all different walks of life, and it's not to say that an advisor can be an end-all, be-all, fix everything that has possibly gone wrong in the portfolio, but there is a notable difference between clients who have had a good fiduciary financial advisor during their working years and who have just kind of gone it alone. Unless you kind of stay up to date on all these changes, all the regulations, all the trends, all the taxes and everything like that, you don't really have a professional in your corner to help manage your life savings, And so I think, a lot of folks that don't have advisors, they may be skewed a little bit more to traditional IRAs because that's the more traditional way of investing. And so if that's you, sounds like you, typically what we'll do to help those folks is just teach them about the different types of accounts. Here's an IRA, here's a Roth, here's a non-qualified and non-retirement account. And then just make sure that you're in the appropriate balance into each of those three different buckets.
Well, the other thing that this Secure Act may have done, Nolan, it sort of was passed pretty quickly. It went into effect. Again, we're only talking on the first day of the year here. This was January 1st of 2020. The Secure Act went into effect. It essentially might have made previous planning that had been done before 2020 kind of obsolete if our intentions were, and if the plan involved passing assets on, tax deferred assets generationally. We're going to have to redo the plan now.
Absolutely. And that's going to have to involve not only the financial advisor, but, whoever is going to be drawing up any of these contracts in the future, because if prior to January 1, if you had a parent pass and they left an IRA to you, these rules don't apply. But starting in 2020, if a parent or somebody who's a non-spouse passes IRA assets on to you, now this is your problem and you have to figure out how to deal with it over the next 10 years instead of, maybe being something you could do as part of the advanced estate planning kind of preservation portion of the working phase.
Well, again, we are talking with Nolan Goslee. He is part of the planning team there at Ron Corser and Associates, Grand Rapids, your planning resource. Give them a call, 616-301-2581 if you need to get that plan put together. If you had a plan previously and now need to update it because of some of the changes that we have encountered over the past year or several years, if it's been a while since you reviewed your plan, you absolutely owe it to yourself, to your spouse, to your family to get that plan reviewed and updated. Or if you'd just like to spot check, make sure no holes have been left unaddressed or red flags are present in your plan, pick up the phone, give them a call. They do offer to answer direct questions quickly over the phone or through the ease and convenience of technology, or invite you in either in person or through technology for that comprehensive review. You can send them all your statements or provide them with a snapshot of where you stand currently, have a discussion about your goals, and they'll go through a very detailed process to arrive at a conclusion on how maybe you can leverage your money, be more efficient with your dollars, or implement more successful strategies. 616-301-2581, 616-301-2581. 25.81. Just reviewing a little bit of what happened in 2020, March 9th, the single largest point drop in Dow Jones history. Now, not the biggest drop as far as a percentage, but the biggest point drop. And then March 27th, the CARES Act was passed. That made all kinds of changes as far as when we had to file for taxes. It made that stimulus check available. It made the PPP loans available. So, just kind of moving through the year and recapping. November 16th, the Dow closed back above pre-COVID levels. November 24th, the Dow broke 30,000 for the first time in history. So we went from March, the biggest single point drop, and what ended up being, Nolan, about a 30% decline, to all the way back at record levels. Kind of what you were talking about in the first half of the program. If somebody tried to time that, it would have been inherently pretty difficult.
Yeah, I mean, what a tough thing to time when you get so much conflicting information. That's kind of part of it. Timing is so difficult when you have official sources saying one thing, doing one thing, and CDC saying one thing, doing one thing, whatever that might be. We're a little bit beyond that at this point, but what we have to go back and say is, okay, if we did try and time this, what might it have looked like? Chances are most people probably didn't get out of the market until we had a couple circuit breakers hit. A circuit breaker, for those who don't know, is once the market drops more than 7% in any given trading day, the market will stop trading for 15 minutes.
Even the market needs some cooling off.
Yeah, just a cool off, essentially, to make it so that people stop selling down so many assets. And so a lot of those happened in very rapid succession back in March. And so I imagine trying to time this and saying, okay, if we had the largest single day drop here on March 9th, and here we are sitting March 15th, and it's looking like the world's coming to an end, and I'm going to try and time that, chances are I'm going to go into a safe portfolio. I'm going to go into a bond portfolio. And what happened less than a month after March 27th, the CARES Act, we had a huge April recovery, and then even recovery deep into May and June. And so if you weren't right back in, chances are you missed the biggest bump. And so one of the things that we always try and coach folks on is, again, like you said, if you try and do timing, you got to get it right twice. We know that investment performance has these dips baked into it. We understand that there are risks associated to owning assets in the stock market. And so I think it's understanding those risks and, understanding what's palatable to you can make you a much more successful investor, where you don't have to, once everything gets bad, get 100% out and then try and guess when to get back in.
Well, looking forward at the year 2021, I mean, looking back, they say hindsight is 2020, and in fact, looking back, it makes it easy. We could have seen exactly what happened in 2020 and say, oh yeah, we should have got out here, we should have got back in here. Makes it very easy in hindsight. But looking forward to 2021, I'm certain that you've got to account for some continued market volatility. That's not a story that's going to leave the market anytime soon, correct?
Yeah, well, my crystal ball's still in the shop, so if you know where the market's going, you tell me, okay?
Right. And I'm sure they would be hired on as a team member there if anybody could do that accurately and precisely. But I don't think that individual is out there.
Right.
And I don't think that really anybody can predict the future of the market. So how do we plan then when we know volatility is going to be an inherent force and factor that we're going to have to deal with?
Sure. So I guess when dealing with market volatility, volatility is nothing new. Volatility is something that's always been around. In a very non-volatile year, we think about 2017. 2017 was a pretty non-volatile year. We didn't have too many days in the market that the market moved greater than 1% in either direction. And that's usually indicative of a volatile year. So when we have clients that are dealing with market volatility or figuring out how to reduce market volatility, let's just explain what volatility is. Volatility is you're taking risks to achieve a certain return, but the volatility is the bumpy road on the way there. You probably will end up with a positive return at some point, but there's going to be potholes. We live in Michigan. We should know what that's like. I would say with the average saver, the average investor, it's more important than ever to have flexibility within your plan so that you can adjust it. Market volatility is not something that's always going to be able to be hedged off the table. There's something called systemic risk, and that's just the risk of investing in the market. You cannot take it away. Whereas within that volatility, if you stay flexible, if you set realistic expectations, if you define your portfolio success, those are the important things to me. So we take actionable, measurable steps in portfolio planning in all environments, whether they be volatile or not. There are usually different areas you can invest in that thrive better in a volatile environment.
So can I paraphrase
Please.
here, Nolan, if you will, if we are properly invested, volatility is going to be an acceptable part of our plan?
Yeah, I would say an acceptable part, and just know where the volatility is going to come from. I mean, if you can delineate your portfolio and say, okay, I have 50% risky and 50% safe assets. Well, if I understand that I have 50% risky assets, I can kind of compartmentalize that and say, okay, if these are going to be my risky assets, I'm gonna go for the gusto. I want real stock market returns. And if I understand that I'm going for real stock market returns with the risky portion of my portfolio, I'm probably going to experience real stock market returns when the market goes down. But it's all about understanding where the risks are, setting the expectation, and really being comfortable with the risks that you're taking on. If you lose 70% in a 2-month period and you're not comfortable with that, chances are you're invested way too aggressively. And so, yeah, it's part of the planning process, kind of just that gut check on how much risk you're willing to take, how much you need to hedge the volatility in your portfolio, and then staying updated on that. I think that's probably, again, where some people miss the mark is they may only ask you what your risk preference is one time during your entire working relationship.
I was about to say, now finding that comfort zone, that's part of your job and responsibility there at Ron Courser and Associates, helping people identify where that comfort zone is. But the question was going to be, as market conditions change, do you find that where that comfort zone is changes?
Yeah. And I mean, that's why we don't put you in a box when we go through a risk assessment, where we don't just say, oh, you're a moderate investor, and so you're going to be just like every other moderate investor. Well, you can be a moderate investor and expect a 6% rate of return, but a 6% rate of return, one investor to the other, you can average out the same thing, but with very, very different results. And so, yeah, it's all just about coming up with what works specifically for your situation. I mean, that's one of the reasons why you work with a professional, same as your tax person. You want to know, how can I reduce my taxes? How can I grow my money better? How can I position my money better for the future? And that's what we really try and do is figure out what those goals are, figure out what you're trying to achieve, make sure it's even achievable, and then build you a pathway to get there.
So again, they are there as your resource at Ron Courser and Associates, Grand Rapids area savers, investors, all surrounding areas. If you've got questions or concerns, pick up the phone and give them a call, 616-301-2581, 616-301-2581. On the other side of market volatility, Nolan, we've got these low interest rates that have been problematic for specifically savers or more conservative investors. Do you think that the low interest rates are going to continue to be a story into 2021 and something we're going to have to deal with?
I would assume so. I mean, we all know what assuming does, and so I try not to, but I would assume so just based on what you hear. When you hear things like the Fed has no desire to curtail inflation all that much, and they're actually targeting moderately outpacing our traditional inflation, usually that means they're going to keep interest rates low. What keeping interest rates low does, it's one of many monetary policies that the Fed can do. But one of the things that low interest rates does is it's supposed to encourage investors to spend more. It's supposed to be an economic boost. And so when you come off of a year like 2020, where you're still experiencing issues of, yeah, the stock market's doing great, but how long are the food pantry lines in Texas? Is that a sign of economic prosperity, or is that a sign of a good market? And so we take all of these things together and say, okay, these low interest rates, if maybe, average to sub the average American is suffering a little bit, lower interest rates are going to help them. They may be able to access mortgages at rates that they may not have been able to afford in years past. So that's usually a good thing for borrowers. On the inverse of that, usually yields will go very, very low. So if you're traditionally a bond investor, yields on bonds are quite low. You're going to experience lower rates on almost all banking investments, whether they be CDs or money markets or even just your standard checking account rate. So when the Fed keeps these interest rates low, there are some good things, but the good things are usually for borrowers. And that's what the government's trying to do, spur borrower investing, get people to take out a little bit more money that they may not have been able to afford, because now they can afford it. And then they have, 30 years more payments going in for your mortgage into whatever financial institution you choose. So usually a win-win for everybody.
Yeah, but things on both sides to consider, because the borrowing and the spending more might be accelerated, might be fostered, but for savers and investors, there's ebbs and flows during our life cycle too, and most of our purchasing is kind of done as we're earning more money, and retirees like to preserve and protect what they've got and then live off the interest when we've got these low yields on bonds and low interest rates. Nolan, is that pushing a retiree into taking higher risk than might be appropriate?
I would say yes in some cases. There have been retirees that I've either talked to who are clients or talked to who, I've met for the first time that are just becoming a little bit more accustomed to taking these risks, whether it be because they want to or they're kind of backed into a corner and they have to. But again, it's how much planning can you do on the forefront so that you don't necessarily have to take all of these risks. Now, a whole lot of risks can be taken in the market to achieve higher than expected results. These risks that are being taken are usually when people just buy up more stocks than they traditionally have. But government securities aren't yielding what they used to. I mean, a 10-year government security, less than a year ago was at like 2.5% or something like that. And right now it's below 1%. So if that's the difference between 1 year ago from now and current, and it stays like this for a year or two, a lot of clients are going to have to figure out how to come up with more yield where bonds used to be able to give them 2, 3, 4%, because bonds just might not be kicking that off anymore. And that's traditionally the most conservative and most predictable income stream for a lot of retirees. So we have to become a little creative.
Are there solutions that we could look to that can help us produce a little bit more yield or income without taking excessive amounts of risk?
Sure. So again, I mean, risk as you want to define it, you're always going to have to diversify your risk. We talk about risky versus safer assets in a portfolio, and traditionally what that means is stocks versus bonds. But you can have much, much riskier stock funds than other stock funds, and you can have much, much riskier bond funds than other bond funds. And so what planning has become is less about what's the overall percentage allocation of your stocks versus bonds, but where are we going to get that yield? If your government bonds are only yielding you 0.5% per year, I'm probably not going to be investing in those. We may look for other types of notes that may be issued by private issuers. Again, working in a fiduciary capacity and being an independent financial advisor, we are able to go shop for a wide variety of products, and we are not captive to any one individual organization. So as the markets change, as planning changes, we change with it.
Going full circle here, back to our conversation about being independent, about being fiduciary, there are inherent and certain advantages to working with a professional with those qualities, ladies and gentlemen. You may want to explore those for yourself and find out more. Give Ron Courser and Associates a call. Nolan Goslee would be more than happy to speak with you. Of course, fiduciary planning team there, looking at your health and your wealth, with additional partner Nancy Courser, Ron Courser's wife. They're looking after the health insurance, Medicare, Medicaid, and all of those associated sides of the business there at Ron Courser and Associates. 616-301-2581, 616-301-2581, 616-301-2581. Nolan, just a couple minutes left in the program here, but you mentioned a couple things. You mentioned inflation. I think this is going to maybe be a factor in 2021 we need to pay attention to. The Fed's already said, as you noted, that they are targeting a higher than average inflation rate.
Yeah, and when we're talking about inflation here, what we're talking about is a gradual increase in the cost of goods. What is not inflation would be a one-time jump in oil prices or a new sales tax. And so those things are typically things that people think are inflation, but they're actually just a part of government risk. I mean, if you could assume government risk to your own portfolio. But yeah, as we go throughout this year, when you have a Fed chair that says higher inflation is going to happen, what this means for investors, it means usually you have a slight loss in spending and purchasing power over time. And what that means is your dollars just buy less in the future than they're buying right now. Inflation-protected bonds and other securities are some ways that people kind of hedge against inflation through the purchasing of some types of securities, but yields remain astronomically low on these types of investments. So even some of the inflationary protected assets just might not be able to keep up.
Again, things that we need to consider as we look at the year ahead. We talked a little bit about taxes. We talked a little bit about market volatility, low interest rates, inflation. I think that we need to keep an eye on estate planning. That was a big item in the news cycle as the pandemic hit. A lot of people were underinsured or not insured and did not have those important documents together. Nolan, there at Ron Courser and Associates, you take a comprehensive look at all of these. You can help an individual chart and map out a course of action and a true plan to help navigate the complex financial world, because we're certain to see some more adventure here in the year ahead.
Yeah, and that's what we really try and do. We try and be the not necessarily one size fits all, but as much of a one-stop shop as you can be in this industry. There's a wide variety of things we have to keep in mind. We have to talk about estate planning. We have to talk about taxes. We have to talk about healthcare. We have to talk about so many things before we even get to the investments. And I think that's really what we try and do here. We just try and focus on that. We try and focus on moving forward. We try and focus on planning and real proactive measures that you can take within your account that you can actually see working on an ongoing basis. So yeah, that's what we do here.
And they are open and available for your calls to help you address your questions or concerns or issues that are on your mind about your planning for your future, your investments, your accounts, your retirement, helping you to understand the risks that you're taking, the fees that you're paying, the taxes you may be liable for, how to maximize Social Security or other sources of lifetime income, how to know when enough is enough. Can I retire? When can I retire? How much do I need to retire? All those are questions that are commonly answered at Ron Courser and Associates. Give them a call, 616-301-2581, 616-301-2581. Those and plenty more. They get different questions all the time, and they're always happy to hear from listeners or viewers of the program. That's what they are here for each and every week, giving us a little taste of the information that they can help you address, but answering those specific questions, extending the opportunity for you to get individual customized answers. 616-301-2581. Nolan, it's great to start the year out here on A Course to Retirement with you. Thanks for being here as our resource.
Hey, thanks so much, Peter. It's been a pleasure. We'll talk to you guys next week.
Tune in to Ron Courser's full radio program, A Course to Retirement, Sunday mornings at 9 a.m. on WOOD, and visit roncourser.com for many valuable resources, including other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. Advisory services offered through Brookstone Capital Management, a registered investment advisor.